Rents continue to drop. We're going to talk about how this ties in with the broader economy and where this economy is headed in the final month here of 2023 and into 2024. First of all, hey everybody, my name is JJ. You're watching Bull, Boom, Bear Bust, back as always with another dose of economic reality. And this economy is based on debt and spending, but the consumer is starting to slow down. And you can see it first in rents. We're going to talk about other things as well, like credit card spending, but rents are definitely a good sign of gauging the strength of the U.S. consumer, and the consumer being the majority, about 70% of the U.S. economy. That's a great place to focus on when you're looking at where this economy is headed. So let's talk about rents. Rents, why are they good to look at? Why is that a good indicator? Well, because people typically don't borrow money to pay rent. It's typically money they have readily available in their checking account to pay month to month. It's typically not borrowed money unless you're really doing some weird stuff to be able to pay your rent, like credit card advances and stuff like that. And I hope nobody here is doing that. But let's take a look at some recent numbers here. This is out of Apartment List. And here's going to be the first example of the slowdown. Last year, 2022, rents started dropping in September. You see the lines right here where my pointer's at. September, October, November, and December. Those are all negative months for rent, meaning prices dropped. Go to this year, 2023, we see rents started dropping in August. We see August, September, October, November, and of course, December numbers are not out yet, but it looks like the decline will continue as far as falling rents. So yes, these are seasonal drops, but a couple things. The seasonal drops began earlier than previous years. This goes all the way back to 2018, and we didn't start seeing rents drop until typically September. This year, rents started dropping in August. And also, if you look back at last year and this year, the amount of decreases have been more significant. Now, you could say 1% is not significant, but when you look back at previous years, it is significant. And look at the gains. The gains in 2021 were about between 2 and 3%, so 2.75%. Now we're down to, during the summer months, the gains are about 0.5%. So the declines are starting to eclipse the gains. Therefore, we'll continue to see the trend of falling rents. Now, why is this happening and not home prices yet? Well, home prices are dropping a little bit, but just not as much as rents. In some areas they are, because people can borrow money to buy homes. That's what it comes down to. When people have to buy something with cash they have readily available and not borrow money, that is going to be a better indicator of what's happening with the economy. And we know the economy is buried under, the consumer rather, is buried under record levels of debt. So it's natural that we're going to see rents continue to decline. And I think the declines are just going to get worse and worse and worse, because all this information we're given about slowing inflation, it's not helping people because prices are still going up. We don't need inflation to slow. We need inflation to drop. We need falling prices, not increases. All right. So most of you know that. I just want to make it clear because there's just so much info out there that's just completely backwards and incorrect that people don't understand what's happening with the economy. I often hear, JJ, where's this economic collapse you've been talking about? It's here. Look at the U.S. consumer. The U.S. consumer is the backbone of the economy. And when the jig is up, when the consumer's maxed out, then the economy's done. And there's all kinds of signs right now that the consumer is feeling the pinch big time, right? Well, let's get into some other news here because there's a lot I want to get into here. I was doing a lot of digging earlier today, and here's something that I found is pretty interesting. And we're looking at CNBC here. Job openings dropped to 8.7 million in October, well below the estimate, but more importantly, the lowest since March 2021. So if the consumer is resilient and things are recovering, we've been hearing about a recovery since 2020, the economy is recovering, then why do we have the lowest job openings since March 2021? And even when we had more job openings, a lot of these were second jobs, part-time jobs, even third jobs. We see people unretiring now, people that were retired at one point now unretiring, going back into the workforce, and they're worried about being discriminated against. Just see my previous video for the story on that one. That's pretty sad here. Job openings totaled 8.7 million, a decline of 617,000 which is a 6.6% drop. That's out of the Labor Department. This was the lowest since March 2021 and brought the ratio of openings to available workers down to 1.3 to 1. Oh, and also I should add, back to the rents. The rent numbers we were looking at, those were monthly price changes. So when you see negative 0.5%, you got to add those up. And year over year now we're seeing a little over 1%. But at the peak, rents were going up between 15 and 20% in a lot of U.S. cities. So you may think that these declines are not big, but compared to a 15% annual increase, this is definitely pretty significant when you look at the difference between the highs that we saw 2021, 2022, and this year. Now, here's an interesting one out of CNBC that really caught my attention here. JP Morgan, the CEO there, Jamie Dimon, he's out there saying Bitcoin and crypto should be banned. That's pretty alarming that he says something should be banned. Now, I think there's a time and a place for crypto. It's a good investment. For the most part, people aren't transacting in crypto, so it's not that useful yet. It's mostly just a speculative investment. And you could say that's what all investments are. You're speculating that the price is going to go higher. But I think he needs to kind of lay off the bashing the crypto. I mean, I'm not huge into crypto, but it is a nice way to make money. It's a good way to trade, especially when you know the market cycles. Now, cryptos are starting to take off. Bitcoin hit 44,000 recently. But to say crypto should be banned, I mean, come on, Jamie. We all can't borrow money at 0% and loan it out at 21%. So give some other people a chance to make some money now. Some people lose a lot of money in crypto, so it can be dangerous. So you have to be very, very careful and know what you're doing. I only buy when there's blood on the streets. I've been accumulating crypto now for a while because prices have been so suppressed, and we're finally seeing prices tick back up. So I'll be taking some gains here, hopefully. Maybe in the next few weeks, next few months, we'll have to see, what this talk of rate cuts leads to, because it is the talk of easy money that I think is going to push the stock market maybe even to all-time highs. I had been predicting or saying that the last 3 years, stocks were peaked out, but now we have this talk of rate cuts, and it's just the talk of rate cuts has investors all bullish and jumping into the stock market. So it could be a dangerous time if something big happens where the plug gets pulled on this economy. We're talking war, we're talking a power outage, a grid down scenario, another health crisis 2.0. What's it going to be? What's going to drop out of the sky here? Nobody knows. So always be on the lookout for that. But otherwise, with the talk of rate cuts, the markets could really take off from here, and we could see crypto take off with it as well, and gold and silver, hopefully. So all of us that have been sitting on these investments for a while, especially my silver stackers out there, you may get rewarded here in the very, very near future. Now, some of you may be saying, well, no, the Fed hasn't said they're going to cut rates. Well, not Jerome Powell, but some other people at the Fed said next year we're likely going to see rate cuts right around March. And that goes right with our forecast that we did, what was it, a couple weeks ago, where we said the average time frame that rate cuts begin after the increase has been about 8 months when you look back at all the previous periods of rate increases. And then, of course, you have a financial crisis that follows, or a severe recession, economic downturn. But the average time from when the rates are increased to when they start dropping them again to come in and quote unquote rescue the economy, it's about 8 months. So that puts us right to March of next year. And that's going to be interesting because next year is an election year. There's a lot of incentive to keep the economy looking as good as possible throughout 2024. So if they're cutting rates, that's going to, I think, throw up some red flags, because usually you only cut rates after what hits the fan, after something crashes, after a bubble busts, after the stock market corrects. Look at 2020 with the drop in the rates. So we'll have to see how it plays out here. But Jerome Powell's being very, very careful about the way he's wording things, because he doesn't want to set off any alarm bells, if you know what I mean. So just think about it. If Jerome Powell in his speeches was to say, oh yeah, we're going to start cutting rates next year, first of all, that would tip off a lot of investors and you would see the markets take off like crazy. But that would also put the message out there that maybe the economy is not so good, and maybe that things aren't so good or as good as he's been saying. Because remember, he's all about the consumer's resilient, the economy's strong, unusually strong. The economy is resilient. The economy is surprisingly strong. All these positive words out there about the economy. right? Now, we're not falling off of a cliff, but we're getting to a point where the consumer can't take anymore. The banks are in big, big trouble. We're going to have to see bailouts, from what I see, at least 20 times the size of what we saw back in 2007, 2008, because of the magnitude of the losses. Now, some of these losses are unrealized losses with their bond portfolios. But what happens when banks need to raise cash? Typically, they sell off these bonds. They'll have to do it at a big loss now. The reason they're unrealized is because the banks are just holding these on their books. But if they need cash in an emergency, they're going to have to sell these off unless they get more emergency liquidity injections, which we are seeing still with the Fed emergency funding program that's been going on since March. It's actually getting bigger and bigger and bigger since March. So instead of getting smaller, indicating that the banks are being rescued and that the banks are on better footing, the rescue is getting bigger, right? So stay tuned, folks, because this is going to get very, very interesting. I see more bank failures to come. Could they print enough money and find maybe a buyer, another bank to buy these failing banks? But when the big mega banks start failing, who's going to buy Bank of America? Who's going to buy Chase? Will they fail? I mean, you let me know what you think down below. I think there's a big risk out there. I think there's a lot of big risks, but it doesn't mean you can't make money. Some investments are starting to move up here, things that we've been talking about here. So, ride the bull, prepare for the bear, get ready for the bear, but still make money, right? We're not all bearish here. We're not all bullish. You've got to look at each individual thing. And we see a lot of investors are starting to sell off real estate now. Maybe we'll start seeing some more inventory hit the real estate market. We're going to talk about that in our next video, because we're going to wrap this one up here for now. Everybody, thanks for watching. Please make sure you like, subscribe, get this video some traction. Thanks, everybody, for being here. Talk to you soon. Keep stacking. Peace.